Hi, my dear buddies, how are you doing? So, guys, today's session very important. We will be discussing the Vodafone case law, the case of indirect transfer. Okay, so kindly concentrate. Uh, Many questions will definitely come, has come before, will be coming, and either way, it is very important for us to understand the entire deal. So this was like a landmark legislation which changed the course of taxation, especially the foreign taxation. So it was extremely important to understand what this entire thing was. So let's go ahead and understand. So guys, very simple. There was this company, Hutchison Telecommunication International Limited. So please come to page number 8.1. I'll explain the case law and then we can go ahead. Okay. So there was Hutchison Telecommunication International Limited, HTIL. It was a foreign company registered in Hong Kong. Right. It had a wholly owned subsidiary called CGP Investments Limited. It was a foreign company registered in a tax haven. Now, what is a tax haven? Cayman Islands. So we had seen tax havens in one couple of classes before. So we saw in these things the taxation laws are relaxed and taxation laws will not apply here. Cayman Islands, Mauritius. So basically, let's say they had invested around 10,000 crore, assume 100% subsidiary. Now, CGP Investments had purchased, right? This one had invested in this one. That held around 67% of shares in Hutchison SR Limited, HCL, right? So basically, this was the holding company, wholly owned subsidiary, and the wholly owned subsidiary had one more subsidiary called as Hutchison SR Limited. It was an Indian company. It was a joint venture of Hutchison and SR Group. Now, SR Group held 33%. SR Group had 33%. They were providing telecommunication services. Hutchison SR, wherever you go, the network follows Hutchison SR. Earlier, it was how it was. Guys, very simple. Again, I repeat. Hutchison Telecommunication International Limited, HTL, registered in Hong Kong. Wholly owned subsidiary was CGP Investments. CGP Investments was where it was a foreign company registered in Cayman Islands, Mauritius, and that held 67% in Hutchison SR Limited, HCL, whereas SR Group also had 33%. Fair enough. All this was absolutely okay. CGP Investments did not have anything else except 67% of shares in Hutchison SR. So Hutchison Telecom had invested 10,000 crore. In that 10,000 crore, they again invested the full amount here, 10,000 crore, to get what? 67% of shares in HCL. So if you think about it, the Indian company Hutchison SR Limited was indirectly controlled by Hutchison Telecommunication International Limited, HTIL. Anyway, what was the holding company of the Hutchison SR Limited? It was a foreign company. Now, CGP Investments and Vodafone International Holdings. This is registered in Netherlands, whereas this was registered in Mauritius. So these two fellows met up in Australia, and it was a share transfer arrangement whereby CGP Investments Limited transferred 100% of their shares to whom? What? 100% of shares in CGP from what? HTIL. Basically, Vodafone International Holdings met Hutchison Telecommunication International Limited and said, bro, your subsidiary, whatever shares you have, right? That shares that you have, full or entire thing we will purchase. We will purchase the entire thing. So Hutchison Telecommunication International Limited, and of course the representatives of CGP Investments are them only. They said you have an investment in your balance sheet, CGP Investments. That investment, a full investment, we will purchase. So ultimately, guys, Hutchison Telecommunication International Limited sold their entire investment, CGP Investments, which is registered in Mauritius, to whom? Vodafone International Holdings BV. This is registered in Netherlands. Where did they all meet? They all met in Australia. So ultimately, because Hutch sold their investment CGP to Vodafone, what happened directly? Vodafone took over which company? Indirectly, Hutchison SR Limited. SR still continued to hold 33%, but the entire control of that 67% went to whom? Vodafone International Holdings Limited. Now, this obviously held outside. So if you see here, to acquire controlling interest in Hutchison SR Limited, which is an Indian company, agreement of sale of shares of CGP took place outside India. It did not happen within the country, happened outside India. I told you, somewhere in Australia it happened. So ultimately, guys, in this entire structure, I repeat again, Hutchison Telecommunication Network. So let me just show you in a different way, right? If you see, income deemed to occur or arise in India, section number 9. So what does it say? Income accruing or arising through or from any business connection in India. Income through or from any property, asset or source of income. Income through transfer of a capital asset situated in India. Just a sec. Right? Then income chargeable and head, salaries earned for services rendered in India. So all this you leave, we have already discussed all these things. You see here, income accruing or rising through or from any business connection in India. Is this a business connection in India? No. CGP is a foreign company. Vodafone is a foreign company. Through or from any property, asset or source of income in India? No. Income through transfer of capital asset situated in India? No. So, Hutch came in, Hutch British Virgin Islands, Hutch India. Outside India was what? Vodafone. So basically Hutch BBI was sold. So basically ultimately is the income received by Hutch came in on sale of shares taxable in India. Shares of a foreign company were transferred. Transaction was between non-residents outside India. Payment was made outside India. Payment was made outside India. Right? So as a result, what happened? Very simple. Hutch came in and Hutch BBI, Hutch India was there. That entire thing was sold. Ultimately, what it became? Hutch BBI and indirectly Hutch India. I have just removed this so that directly I have shown Vodafone and Hutch India in this. Make it easy. Vodafone, Hutch SR. In between, one or two things were there. Don't want to confuse. This much is enough. Okay. This is the entire stuff. So then eventually what it became? Vodafone Netherlands became Vodafone British Virgin Islands and Vodafone India. So if you see here, then this is British Virgin Islands. Ultimately it became what? Vodafone British Virgin Islands, and eventually Hutchison SR was renamed Vodafone India. Right? Now, come back. It was a cool case, nothing happened, no tension. But there was a very, very smart assessing officer. Correct? Srivastava. OP Srivastava, if I'm not wrong. So Mr. OP Srivastava said, bro, okay, you are saying CGP investment is outside India, okay. You are telling Hutchison Telecommunication International Limited is outside India, okay. And you are saying Vodafone also is outside India, okay. But he said, bro, but the underlying assets are in India. Since the underlying assets are in India, this would come under which one? If you see, income through the transfer of a capital asset situated in India. It is income generated through what? A transfer of a capital asset. Capital asset would be underlying asset. Through the transfer, issue went to Bombay High Court. Bombay High Court came out with a amazing decision. What did Bombay High Court say? Bombay High Court said, check it out, the transfer of shares by CGP Investments, by whom obviously HTIL, Hutchison Telecommunication International Limited, to Vodafone, this one, obviously that's entire sale, amounts to a transfer of controlling interest in an Indian company, Hutchison SR Limited. Even though you are transferring CGP, ultimately controlling interest of Hutchison is going there. Point number one. The dominant purpose of sale of shares of CGP was to transfer. What is the purpose of sale? Transfer the controlling interest. The High Court said assessing officer is 100% right. Of course, it went to CIT appeals. He also supported the AO, went to High Court. Bombay High Court said OP Srivastava is 100% correct. We should reward the man for his brilliance. In fact, I think OP Srivastava went on to become the CVDT chairman. He was rewarded. So they said, boss, you are not transferring CGP Investments ka shares. You are not even transferring. What are you transferring? Controlling interest of Hutchison SR. You are transferring controlling interest of Hutchison SR. Vodafone has acquired a source of income in India, that is Hutchison SR Limited. By reason of this transaction, it has earned capital gains, which is taxable. Correct? HTIL, Hutchison Telecommunication International Limited. By selling the source of income in India, it has what? Earned capital gains taxable in India as the income earned towards the sale consideration of the underlying shares. Underlying shares. Brilliant. Subject matter of the entire transfer as contracted between the parties is not really shares of a Cayman Island company, but the asset situated in India. That's all. These are the exact wordings. So I have written on pointers. I'm reading that out. I repeat, the subject matter of transfer as contracted between the parties is not actually the shares of a Cayman Island company, but the asset situated in India. Deadly. Vodafone was therefore liable to deduct TDS. Vodafone paid the amount. Bro, where is the TDS? TDS only have not deducted on the payment made to HTL, and therefore what was sent, guys? Show cause notice was sent. Capital gain. Let's say if it was sold for 60,000 crore, assume 60,000 minus 10,000, 50,000 50,000 crore capital gain, 20% tax, 10,000 crore. Section 195 TDS you did not do, 20%, for which you need to pay 10,000 crore. And I released a show cause notice under section 201. I had given a 201 order. The OP Srivastava had given that order. Bombay High Court said show cause notice is 100% correct. The show cause notice is undoubtedly 100% correct. Deadly case. Deadly case. This went on to Supreme Court. And it is said that though, judiciary is extremely pure, there are certain black marks in the judiciary. And it was held that this is one such case, which was a black mark in the judiciary. It has been alleged that the judiciary was sold on this one because, guys, I'm talking about a 10,000 crore tax, what do you say, collection, and such a big company called Vodafone. And it was more than tax planning, etc. It was tax avoidance and tax evasion, whatever you did, is what the allegation was. And Supreme Court, unfortunately, overturned the High Court's very good decision. High Court, whatever they had done, was a very, very good decision that was overthrown by the Supreme Court. Overthrown by the Supreme Court. Completely overthrown. By whom? By the Supreme Court. 1 second. Yeah, there you go. For example, landmark Indian judicial on tax planning, SC in McDowell case. Tax planning is legitimate if it is within the framework of law. Colorable devices cannot be part of tax planning. Colorable devices means what? Something that breaks the entire concept of tax planning. For example, this one. Whatever they did was usage of a colorable device. Ultimately, the objective was to evade tax. Principle of Duke of Westminster, taxpayer can arrange his affairs as to reduce tax liability is dead. Basically, it said that you should obviously tax avoidance scheme you should ignore is what he said. Supreme Court in Azadi Bachao Andolan case, an act which is otherwise valid in law cannot be treated as invalid merely on the basis of some underlying motive, supposedly resulting in some economic detriment or prejudicial to national interest, if it is valid in law, is what the Supreme Court said. But in this particular case, what you did more, if you see the intention, it was to evade tax. It was to evade tax. Anyway, guys, Supreme Court, very, very bad decision. The revenue should look at the entire transaction as a whole and should not adopt a dissecting approach. They cannot dissect it and say, no, you're wrong here, you're right here. That's what they did. Every strategic foreign direct investment coming into India as an investment destination should be seen in a holistic manner is what the Supreme Court said. The offshore transaction herein is a bona fide structured investment in India. Income Tax Act does not cover indirect transfers between non-residents outside India. That's what happened, indirect transfer. Under the Indian Companies Act also, the situs of the shares would be where the company is incorporated and where the shares can be transferred. Therefore, the situs of the shares is Hutch BVI. Is in British Virgin Islands and not in India. Situs means where the position of the shares are. Therefore, shares of the Indian company was not transferred, they said. One of the worst decisions ever. India currently does not have any anti-abuse provisions to tax planning opportunities. This also came later. GAR, General Anti-Avoidance, regulations. We'll see that later. Because of this stupid Supreme Court decision, many amendments came. One of the amendments was GAR. This observation he made, no, India currently does not have anti-abuse provisions. Pranab Mukherjee, like, bro, we'll make. Taxpayer is entitled to arrange his affairs as to reduce tax incidence. In the absence of sham or colorable device, it is not considered as tax evasion, is what they say. Difficult to say that Hutch India or Vodafone was a fly-by-night operator, basically short-term investor. Hutch operated in the telecom sector since 1994. Hutch has made significant contribution to the kitty of revenue by way of taxes. Hence, amount received on sale of shares is not deemed to accrue or raise in India, and hence India would not have any right to tax such income. Worst decision ever, to be honest. Worst decision ever, because you are not selling some, come on guys, you are not buying CGP shares. You are buying what? Obviously, the shares of Indian company only. It was a very, very, very stupid decision. Right? That's all, guys. After that, Pranab Mukherjee said, bro, enough is enough. brought about retrospective amendments. Retrospective amendments. Deadly amendments. One, we'll come to this. One, they changed the definition of transfer under 247, First Amendment. Second, they changed the definition of capital asset under 2 clause 14. And third, they covered indirect transfers under section 9. Amazing. Because of this, and guys, they did a retrospective amendment from 1962. Pranab Mukherjee did not keep quiet. Did not keep quiet. First Amendment, if you see, 2 clause 14, let's see. An explanation was added, definition of capital asset. Just show you. See here. This explanation was added. See here. Inserted by Finance Act 2012 by Pranab Mukherjee with retrospective effect from 1/4/1962. In a capital asset, property is being transferred. Property is also capital asset. What is property? It is hereby clarified that property includes and shall be deemed to have always included from where? From 1962. Any rights or in relation to an Indian company, including rights of management or control or any rights whatsoever. So guys, here, by transferring CGP investments to Vodafone International, you may not be selling Indian shares. Okay. You may not be selling Indian shares, no problem. But you are selling property. What is property? Rights. So by selling CGP investments to Vodafone, you are selling the rights of what? Management control. Beautiful. 2 clause 14. Are you understanding? Including rights of management or control or any other rights whatsoever. So first change was 2 clause 14. 2 clause 14. Next, the definition of transfer. 2 clause 47. This transfer. For the removal of doubts, it is hereby clarified that transfer includes, and you see this also, 2012 with retrospective effect from 1/4/1962. For the removal of doubts, it is hereby clarified that transfer includes and shall be deemed to have always included disposing of or parting with an asset or interest therein. What interest? Interest in the Indian company. Or creating any interest in any asset in any manner whatsoever. How am I creating an interest? By transferring. Directly or indirectly. Absolutely or conditionally. Voluntarily or involuntarily. Tomorrow if hostile takeover happens, that is also covered. Adani did a hostile takeover of NDTV through other means. That also is covered. Just saying, if it were to be a foreign company, I'm saying. By way of an agreement. Now this deadly line. Whether entered into it in India or outside India. By whom? Here it is in Australia. Or otherwise also, I don't care. Either through an agreement or otherwise. Even if agreement is not there, I will deem it to be a transfer. Notwithstanding that such transfer of rights has been characterized as being affected or dependent on flowing from the transfer of a share or shares of a company registered or incorporated outside India. Deadly. Notwithstanding means what? Even though such transfer of rights in which company? Indian company, has been characterized as being affected or dependent or flowing from. It's flowing from where? Flowing from the transfer of share or shares of a company registered or incorporated outside India. CGP investments. Are you seeing? Brilliant. Brilliant. And of course in section 9. In section 9. Explanation 4 and 5 are added. See in this dialogue, through or from business connection, through or from any property, through or from any asset. This is the fourth one, no? Through the transfer of a capital asset situated in India. Through or from is not there. Supreme Court said since from is not there, India, from, nothing is coming from India. It is through. Am I going through an Indian company? No. It's going to some foreign company. Is it coming from an Indian company? No. That from word is not there. So it means it will not cover, is what they told. Wrong decision. Very bad decision. That's why they inserted what? Explanation 4. The removal of doubts. It is hereby clarified that the expression through shall mean and include, and then deadly. They are telling, bro, it always meant also from 1962 itself. It shall be deemed to have always meant and included. What? By means of, or in consequence of, or by reason of. Means what are they saying? By means of. By means of. Means what? By means of means capital asset, ultimately underlying asset should be in India. That's what it means. By means of, in consequence of, or by reason of. Then explanation 5. Explanation 5. Share of CGP were sold, no? Share of Indian company were not sold. So explanation 5. The removal of doubts. For the removal of doubts. Here. Hereby clarify that an asset or a capital asset being any share or interest in a company or an entity registered or incorporated outside India shall be deemed to be and shall always deemed to be to have been situated in India if the share or interest, for example, I will tell you, it is hereby clarified that an asset or capital asset being any share or interest in a company or entity registered or incorporated outside India, CGP investments, shall be deemed to be and shall always be deemed to have been situated in India. CGP itself is situated in India. If the share or interest derives directly or indirectly its value substantially from the assets located in India. Deadly. If the value substantially is from the assets located in India. 66.67% substantial value of Hutchison SR Limited is held by CGP. Now, what is this substantial? We'll see later. But just know that yes, 66% is, you can also say it's substantial. Substantially, it's being derived from whom? Indian company only it's derived from. CGP is just a holder of shares. That's all. Custodian, you can say, nothing else. So by this amendment, shares of Mauritian or Cayman Islands company which has investments only in India shall be deemed to be situated in India as it would derive its value substantially from assets located in India. Substantially word was not actually defined. Is it 20%, 50%, 51%, 75%, 100%? Don't know. We'll see that later. Term amendment, the amendment came from 1/4/1962. Deadly.